Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical driving markets at the moment. Whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30, 40 minutes or so. Very busy webinar today. Obviously, lots going on. We'll look at our usual place, just how markets are shaping up for the week. Generally, we'll look at stocks, the S&P 500 mainly, the NASDAQ and the Dow, and we'll look at some of the technicals around those major US indices. We'll then quickly review last week's two key events, which were the RBA meeting and the Bank of Canada meeting, both surprising with rate hikes again. Before then, we get into the meat of this week, huge events coming up. So we look at US CPI and the Fed. We'll look at some technicals around gold as well. We'll then look at ECB and Eurodollar, and then also the Bank of Japan meeting and dollar yen. Hopefully, if we do have time, there is some important UK data as well coming out, GDP, but more importantly, wage earnings and jobs data out of the UK Tuesday. So hopefully we can get to look at that, and cable as well, which is doing pretty nicely at the moment. That's sterling against the dollar, of course. Okay, let's first just see how markets are shaping up currently. This is, of course, the S&P 500, which we normally like to look at. I'll just put it onto a weekly, actually. Obviously, this week, all eyes on the main risk events, as I say, huge central bank meetings kind of priced in, but we'll look at those in depth shortly. Also, we have that US inflation data, of course. European stocks kind of kicked off on the front foot, actually, after a mixed Asian session. Chinese markets quite subdued, but US futures are quite nicely in the green actually at the moment, or they've just come back slightly. Just checking out live prices at the moment on this screen, you can see US futures here just up 0.17, S&P 500, NASDAQ futures up 0.41, so nicely in the green to start the week. FX markets seeing some downside pressure, slightly eased on the dollar, but selling in the dollar really yield differentials actually. So the difference between the US yields and some of the other major currencies, so sterling, euro, slightly in favor of those two currencies at the moment. Cable actually, as I said, doing quite nicely, did get close to 126 actually for the first time in a month. Euro dollar sort of regained a little bit of momentum, slightly given that back now, was above, at least still above 107.50. Aussie actually hampered by thinner trading conditions because of the bank holiday in Australia. As for stocks, so Wall Street's benchmark, that's the S&P 500. That inched slightly higher on Friday, quite slightly subdued trading, really. Not surprising before these big events. Traders kind of largely on the sidelines, ahead, of course, of the Fed and also that US CPI data that we get tomorrow. S&P 500 ended up very small, 0.1%, having reached actually a 10-month high in intraday trading. The gain pushed actually the blue chip stock index deeper into bull market territory as it rose over that 20% mark, which denotes sort of bull market in inverted commas. That's from its most recent low in October. Trading S&P, as I say, slightly subdued, muted really, actually the lowest daily trading volume since October last year. Of course, expectations of a Fed pause gaining steam. That gained steam after US initial jobless claims data on Thursday. That pointed to a slightly cooling labor market, which is pretty hot, or has been pretty hot recently, especially in those non-farm payrolls headline figures. On a weekly basis, then the S&P rose 0.4% to record its fourth consecutive weekly gain. And that streak, as you can see now, is up to the 61.8 fib level that we have here of last year's decline. So that level, probably for us, important resistance to this move higher. That's at 43.11. You can see here. Interestingly, just before we drop to the daily, actually, if we do get above this resistance, then also you can see just above there is the mid-August high at 43.25. So sort of 43.11, 43.25, an area of resistance for us in the S&P 500. If you look here, interestingly, a little bit of divergence between the RSI, which hasn't really quite made a new high, but we made a new high on Friday, 43.22 there, although we closed obviously below that, below 4,300 in the end, 42.98. So interestingly, slight divergence there in or between the RSI and prices, whether that means a slowing in this bull trend and even this upside break yeah, there's a signal there for us at least. Otherwise, we get back into this range, which would be sort of around and above 42.50 for sure. You can see that upside break on the daily. So strong, probably decent support around 42.50, which is the bottom end of this recent range. Otherwise, if we fall back, then certainly 4,200 was where everybody was looking beforehand, of course, before we broke higher. Around that level, you've got that early February high, 41.95, and just the 4,200 sort of psychological level as well. You can see we're well above some of these long-term moving averages as well. So just interesting, yeah, big week, of course, and just a small warning sign there whether this uptrend will pause with 42.50 for us, important initial support. On the NASDAQ, of course, let's just pull that one up. Sorry, just lost my train of thought. We'll go to the weekly first of all. We've been highlighting this for quite a while, really. Of course, with the Fed pausing, then potentially pausing, of course, then big tech gains on that scenario with less rate hikes. Of course, tech-heavy growth companies don't especially like higher rates. So the NASDAQ has certainly been doing well this year and was boosted on Friday, gained 0.2%, or sorry, 100. The NASDAQ 100 gained 0.3% on Friday, boosted by a 4.1% jump also in Tesla. In case you missed that, the car maker's shares rose for an 11th consecutive day after it locked in another deal. It locked in Ford a few weeks ago, and now GM, so General Motors customers can use Tesla's electric vehicle charging system. As I say, a similar agreement to the one struck with Ford last month. So interesting, that boosted the NASDAQ slightly on Friday. And you can see on the weekly chart, 6 consecutive weeks of gains for the NASDAQ. Interesting now, we've got above that fib level, that 61.8 fib level, which is of the 2022 decline, really, or just before then, October high down to sort of, yeah, the October low. So that 1 year decline, the fib level, important level, 61.8 is at 14,349 on the NASDAQ 100. So we're above that. You can see, yeah, those consecutive weeks, but certainly for us, it was this break above, firstly, the mid-August high at 13,720, and then certainly this break above the 100-week moving average. That's that light gray line there. You can see it capped resistance in August, but then we've broken strongly above that. It's now at 13,433, so a very strong push higher that you can see, but we are now we don't have divergence really because we made that high, but we made a high in the RSI as well, and that's overbought slightly now, 71.98, so sort of overbought territory, 70 and above, but doesn't mean we can't go higher, as you can see around here, sometimes warning of a pullback, but doesn't mean we then go higher again. So interesting for the NASDAQ, if we just look at the daily, you can see sort of consolidation here, that fib level. You just pull it back at 14,349, as I said, up there, sort of just about capping that sort of sideways trading slightly. The lows in that range being 14,216. So that'll be important support, you think, if we do track back into this sort of 14,216, so 14,200 or so up to sort of 14,500. Important, really, consolidation levels of support in the NASDAQ. If we just drop to then the Dow quickly, We've signaled this for weeks now, really. It's important, really big level of resistance, really. 34,281 in the Dow. You can see it capped the upside numerous occasions over this year and even before then, sort of November and through January. And then even in May, we sort of held up with the 50-week moving average. That's the blue line there, 32,734. And then we've just got above, actually now, interestingly, the 100-week moving average, 33,603. So whether we can build on that, but then we get towards that 34,281 level for us, huge resistance. You can see on the daily there. Just capping that upside. So really interesting whether we get to that or not. Can push above, but big resistance for us at that level for the Dow. Okay, let's quickly review, first of all, the RBA meeting. We'll go to the Aussie dollar. I should say, if you do have any questions, please do ask them along the way. We do have a chat box there, a Q&A box, I think you can see. So do ask any questions if you're unsure about what I'm talking about, of course. If you have any questions on it, or even just the setups, what we're seeing correlating to obviously fundamentals, which is how we look at markets really for us. Okay, quick review of the RBA. As I said, surprised markets, raised rates further by 25 basis points to 4.1%. Majority of analysts had expected an unchanged decision after the RBA already restarted hiking rates last month. The bank really, they assume that inflation has passed its peak, but still sort of near 7% is much too high still. Recent data also indicated upside risks to the inflation outlook have increased. The hike should provide greater confidence that inflation will return to the sort of 2-3% target that the RBA has within a reasonable time frame. Growth in Australia has slowed and conditions on the labour market have eased, but they do remain very tight. Wage growth also picked up in response to those tight labour market conditions and also high inflation. So the RBA basically remaining on alert really to the risk that expectations on ongoing high inflation contribute to potentially larger increases in both prices and wages, especially given that limited spare capacity in the economy and still a very low rate of unemployment. Further tightening may be required, and I think I don't want to complicate things too much, but this is what I look at with a background in fixed income and bond markets. But you can see this is the Australian 2-year government bond yield, something tricky to trade for sort of retail guys, but really points to where markets are. This correlates, of course, closely to the bank's cash rate. And so you can see just sort of, we did have resistance, interestingly, around sort of 3.7%, and then we just smashed through there sort of a couple of weeks ago. And then you can see on, Wednesday, really, after the main event, after the RBA surprise, shooting up higher, above 4% to 4.05%. So what does that mean? It means markets expect another rate hike for sure. Yes, probably pricing in at least one more 25 basis point hike, which take rates to 4.35%. As for the Aussie, let me just pull that up. So Aussie against the dollar. I brought it up earlier. You can see we're back in that range. So it looked like we were breaking down sort of below 66, 68, the range, broke down below it, but couldn't hold it really below 65, printed at 64.58, and then we pushed back above there, and we're back into near the top of the range now at 68. So 68 for us, a key level of resistance. You do have as well that 100-day moving average, that grey line, just expanding there, which offers, potentially now support. We've broken that today. So that's at 67.37. It's capped the upside. You can see a few times already recently over the past few months. So interesting. If we can push above that, then we go towards 68. You can see interesting fib level actually for this move from October up to sort of the highs in early February. The halfway point of that is at 66.63. So sort of middle part of the range there, and we pushed above that nicely and above those all those long-term moving averages. So the light blue line for you, some of you guys might not know, 50-day moving average, 100-day moving average is the gray line, and the black line 200-day moving average. So pushing above that strongly in the Aussie. Interesting whether then we get well, we've seen decent support in some of these commodity currencies, of course, with these surprise hikes by the RBA. And then, of course, the Bank of Canada followed it up, matched the RBA. They hiked rates as well by 25 basis points to 4.75% now, that rate in Canada, the highest in 22 years. They also continued, actually, the Bank of Canada, its quantitative tightening. Just looking at that meeting then, it had paused its hiking cycle since January to assess the impact of previous tightening on prices and activity. But then Q1 growth was stronger than expected. The bank actually acknowledged that consumer spending was surprisingly strong and also broad-based. And then demand for services, but also for interest rate goods, had increased. And then also we had housing activity had picked up, and the labor market still remains strong. So essentially, the bank concluded that excess demand is more persistent than expected. Surprise policymakers, and inflation ticked up as well in April to 4.4%. So really, the Bank of Canada expects inflation actually to ease to around 3% in the summer, but the core inflation rate will hold around sort of 3.5–4%. That range, which means excess demand will continue. And then there are, of course, concerns have increased that the CPI could get stuck above the Bank of Canada's target, which is 2%, and that justifies more additional tightening. Again, if we just look at, I don't have it on, I don't have it here actually, but the 2-year Canadian government bond yield jumped almost 20 basis points at the time, actually, to over 4.5%. So certainly markets expect another additional rate hike either in July or at latest in September. And you can see really loonie strength. You can see consecutive down days in. This is obviously dollar CAD, so the CAD is strengthening if this pair goes down or falls, and you can see decent levels or decent consecutive days of falls. That's the Wednesday after the Bank of Canada decision, and it broke that sort of near-term dotted line there, near-term support level, which had capped the downside on a couple of occasions you could see over the last few weeks. So we've broken down below there. So really now we're targeting probably that early February low, the year-to-date low as well, which is 132.62. Interesting, if we just check back then, sort of 136 caps the upside, sort of double tops, if you like, potentially, I guess, which means if we do sort of break the lower level of the double tops, which we have done around sort of 134, touch below sort of 133.70, then potentially 133.70, where are we? 136.40, so 270 or so. We could fall down 270 pips or so below, say, that 133.73, so 131 potentially, but obviously we've got this big level of support around 132.62. That's dollar CAD. Okay, moving on to this week. Just let me pull up a decent graphic for you. So first of all, we'll look at US CPI. That's out on Tuesday tomorrow, obviously a few hours ahead then. Well, what is it? 26 hours ahead or so of the Fed meeting the following day. Economists expect a rise in CPI month on month to, a rise of 0.3% in May, so a little cooler than the prior 0.4%. The annual gauge is seen easing to 4.1% from 4.9%. So you can see that that's the yellow line, really, the orange line, headline still falling, 4.9 from 4.9 to 4.1%. That will be the lowest reading since March 2022, so last year. March 2021, actually. So, yeah, the lowest reading, 4.1% since then. The headline will be driven by a 3% decline in energy prices. As we know, if you follow, obviously we follow the CPIs, we know that energy prices have fallen back to sort of pre-Ukraine invasion levels. So that's the case for every inflation marker across the globe. Really, we're back. The headline is being driven by those falling energy prices. But then, of course, if you look at the core, that strips out volatile food and energy prices, which is obviously more important, really, and certainly for those base effects, which are bringing down that headline number. Food prices, though, just to mention, are anticipated to increase slightly due to a rise in food away from home, and that partially offsets by a decline in food at home. And then for the core measures, well, that's forecast to rise 0.4% month on month, matching the pace in April. And the annual core measure, so that's that blue line, is seen cooling slightly, but still sticky around sort of 5.5%. The core measure seen cooling to 5.2% year on year. The rise led by a significant increase in used car prices. And then if you look at, we've talked about this, then core goods prices against core services prices. The core goods prices, excluding used cars, are expected to remain little changed. And then the core services prices, they're seeing a 0.4% increase, economists reckon, and that is underpinned still by shelter inflation. Eventually that's meant to come down, but then offset again by a decline in lodging away from home. So certainly still punchy numbers. A lot depends on the Fed decision and anything we get, especially in that 0.4% month-on-month increase in the core. Anything 0.5 will certainly put the cat amongst the pigeons for the Fed, and a potential 25 basis point increase on Wednesday. If we think about it, and we've highlighted this a lot actually, or in the most part over the last few months, certainly in some of our weeklies and also our daily commentary that's on the website, 0.2% month on month is a key number for the core, and what the Fed is looking for to drive down inflation back to its target nearer 2%. So 0.2% month on month. If we're getting that, then certainly the Fed would be more confident that then the headline rate and, well, the core rate as well would be coming back to 2%, but we're not there yet. Okay, as I said, anything sort of 0.5, then that's a shock, and certainly possibly convince enough Fed members to vote for a hike Wednesday. As for that meeting, I've just got a graphic which I can show you hopefully here. Oh, well, before we get to the graphic, actually, yeah, you could just see, well, we've got the ECB 24 hours or so, well, less actually, for 18 hours or so after the Fed meeting. So this is a graphic of what's priced in by money markets, done last week actually by one of the investment banks. But you can see the grey chart, the bars are the ECB, the orange are the Fed, and just interesting. So not a lot priced in for June this week for the Fed, whereas a 25 basis point is nailed on for the ECB. And then you can see another 25 basis point hike is pretty much nailed on at some point in the next couple of months for the ECB, whereas you can see a 25 basis point move is much more priced in at the Fed's next meeting, late July, that is, and we'll get into that shortly, the odds. But then you can see potentially rate cuts. They have been priced out, and we'll talk about that shortly, but then rate cuts back end now of this year. So certainly not sort of summertime, autumn time, but possibly very marginally in December, but otherwise starting now in January 2024, those rate cuts, as this is obviously predicted by money markets. Okay, let's get into the Fed then. And you can see the graphic. Hopefully this proves useful. Just some interesting numbers that the policymakers are sort of battling with, if you like. Generally, economists expect the Fed to hold rates at 5 to 5.25%. I think only 8 of the 86 surveyed on a Reuters poll forecast a 25 basis point rise. You can see here, so 78% chance that the Fed stands pat, really, unchanged rates. So sort of 22% or so chance that they raise rates. If we just step back, actually, we think it's interesting, and we'll get to these numbers, really cover those. But just over a month ago, if you think, Chair Powell hinted that after, remember, 500 basis points of rate hikes over a 14-month period, interest rates may have finally entered restricted territory, and the Fed could pause at this meeting, really to take some time to evaluate the effects. Markets kind of took this as a signal that we may already be at the peak, with the fears that the combination, of course, of high borrowing costs and certainly these tighter lending conditions that we've seen after the banking crisis in March could then prompt a recession, with inflation falling swiftly back towards its target. So early May, Fed funds futures were pricing in around 86 basis points of interest rate cuts, as I mentioned that before with that bar chart, by year end, and the target range heading below 4% at the January Fed meeting in 2024. That said, has kind of been reversed then over the next 6 weeks. We've had activity remained resilient. Inflation continues to run pretty hot. Payrolls, of course, they jumped 339,000 in the last report. And then, of course, we had the Australian RBA and the Bank of Canada surprisingly hiking rates. We also had sort of slightly hawkish comments from quite a few Fed officials, adding to the sense that their work may not be done. The result was that pricing for this meeting this week was not far off a coin toss, actually, 50-50. With July certainly looking a very good bet for a rate hike. Slightly changed that now. Up to date then, markets sort of coalescing around this idea of a skip, which we've mentioned in the daily commentaries at least. So the Fed will pause at this meeting, as we say, 78% chance of that. And then really they're allowing themselves time to assess the impact of this previous rate hike cycle, the most aggressive in at least 40 years, certainly as tighter bank credit kicks in potentially before then considering another rate increase, 26th of July, that is the Fed meeting, I think, in late next month. Certainly kind of seems prudent, doesn't it? To certainly avoid sort of accidentally over tightening. Definitely, though, we've had kind of mixed data, really, with sort of economic downside risks appearing to have diminished slightly, with resilience in some of the hard data, like spending, like the labor market, but then also some weakness in some of the PMI survey data. Which is leading indicator. We've got the inflation numbers there. As we said, we talked about that already. They come out tomorrow. Interestingly, I think we had Goldman Sachs recently lowering their outlook on a recession, assigning or giving it a 25% probability from 35% before. And they argued actually that progress toward a soft landing is on track, supported by improvements in the jobs market and cooling wage growth. And that's certainly what we saw at the NFP. We went through that last week, actually, but that's wage growth coming back from 0.5%, if you remember, month on month, down to 0.3% month on month. And then also the unemployment rate, the jobless rate, picking up from, well, let's not forget a very historic low, 3.4%, multi-decade low, but popping up to 3.7%. So sort of mixed data for the policymakers to contend with. Certainly core PCE inflation, which is a favorite measure of the Fed, that's fallen less than expected, although a significant deceleration is anticipated later this year. And then Fed officials have kind of potentially less reason to be concerned, certainly compared to last summer, as inflation psychology normalizes potentially and signs of cooling emerge. Money markets then, they price in, where are we? Less than a 20% chance, as I've said, for a hike Wednesday. But then around a sort of 75%, 80% chance of a 25 basis point hike in July. Going forward, in fact, I'll just show you one of our favorite websites, of course, to track these things, is CME Fed Watch tool. Hopefully you guys look at this quite a lot. You look at these quite a lot. Hopefully, especially Fed funds futures, so it gives the specific predictions of money markets at each specific Fed meeting. So you can see 14th of July, obviously this week, then 26th of June, sorry, 14th of June, 26th of July, and then the other Fed meetings, FOMC meetings through the year. It's CME Group, and you can see the sort of link there. Hopefully you guys follow this because it's certainly interesting and drives markets for sure. You can see not a lot of change there, but if we go to July, in fact, you can see the chances of a rate hike sort of 60. Well, I gave it probably too high. It depends what you look at, but on this front anyway, sort of 67% chance, 2 and 3% chance just over on these. Well, this is swaps really, but giving that 67% chance of a rate hike, at least 25 basis points in July. And if we look at where we've come from, you can see 52% for a 25 basis point. That came from 10% a month ago. And you can see then the rate cut even a month ago was nearly sort of 30%, 29% for a rate cut at the July meeting now, a zero chance of that. And even a week ago, zero chance of that now. If we just look, always good to look at the end of the year, just where we move those rate cuts, as I say, if you look at, say, 4.25% to 4.5%, so that's at least 50 basis points of cuts, 44% chance of that a month ago, now pretty much no chance of that. And then you can see sort of a rate hike, 25% chance of that rate hike coming, certainly, or level staying at 5.25% to 5.5% by then, zero chance of that a month ago. Okay, hopefully that makes sense to you. Don't see any questions, but please do ask questions if you do have them. So going forward, the Fed, it seems they are still very close to that peak policy rate, though certainly the caveat will be any kind of higher CPI reading, which could potentially shift those odds to a hike this week. As I've said, policymakers, they want to see that 0.2% month-on-month reading. As I've also said, we're not there yet, so really they probably can't leave the door open, or they will, sorry, leave the door open to do more. And in a way, you'll get a sort of hawkish skip scenario. I think I've been reading somebody put on Twitter a hawkish no hike scenario, essentially. And that could be reflected then. We do get the dot plots. So that's the FOMC members' projections of Fed funds rate. Just looking at that, then in March, they signal rates would be left in a 5 to 5.25% range through to year end, with rate cuts next year. So only minor tweaks probably predicted in their forecasts. The big risk certainly is that even if they do hold rates steady this week, then they insert kind of potentially a further hike into their central forecast. And that will see markets certainly firm up that 25 basis point move in July for sure. Also, of course, we get the accompanying press conference with Chair Powell. Certainly language, tone of language will be key, potentially continuing to emphasize that they do not, Chair Powell, the Fed, do not expect to cut rates this year. And the risk for rates remain firmly to the upside. So that's kind of expectations. Anything different, then markets will move for sure. We also get, that's kind of the Fed. Hopefully that's sort of clear enough for you guys. We do get retail sales as well on Thursday afternoon. Market median estimates are flat reading after 0.4% growth in April. Auto sales, probably the drag in May. Momentum then is forecast to ebb further through this year due to certainly high sticky inflation still, weakness in the housing market potentially, and then higher rates really feeding into the economy. I said we'd look at gold. So bear with me 1 second. Actually, what am I doing? So gold is here. So price action potentially certainly going to be affected by the Fed if they do anything. At the moment, nothing priced, of course. Kind of remains range bound. You can see this is gold, then the gold daily chart, range bound at the moment, pretty dull at the moment. So waiting for a catalyst. Certainly we can get that this week. We're actually tracking, I'm struggling to break the 21-day moving average, which I haven't got on here, but bear with me 1 second. Yeah, well, we're tracking around the 21-day moving average anyway, around 1965, that is, I think. Support remains firm below a sort of 1940. You can see here then the 100-day moving average, that's at now 1941, the sort of bottom of this recent range. So decent support there, you'd think. We've got in a fib level of the move higher this year, really, and the halfway point is at 1935, so the 50% mark. 1935 for this move higher, so sort of a zone of support 1935, 1940, you'd think, in gold, and then the upside probably capped by, well, there's the 50-day moving average at 1990, and the top of the range, the range is just below there at 1985 or so, 1983. 1983. So yeah, there's your range, and potentially, I always say this, but the longer we track sideways, then the bigger the breakout will be. Normally in line with the dominant trend. Do we have a dominant trend? Well, long-term trend is for higher prices, you can see there, and we're kind of just about keeping in this upward trend channel, if you like. Should really stretch that a touch. So let me just stretch that. You can see we're just about tracking the bottom of that, bottom of the, yeah, this upward trend channel. So if that acts as support, potentially, along with, we've got this high here, which is the February high at 1959. So potentially, if we do move above there, then certainly top of the range, 1980, 85, and then looking towards sort of 2000, that key psychological level in gold. Okay, then let's look at the other main events. We've got the BOJ, of course, and also the ECB. Just got to crack on. Don't want to be too long for you guys. So this is the graphic on the ECB. Hopefully these graphics are helping you as well. Meeting on Thursday, certainly fully priced for a 25 basis point rate increase. Actually, a touch more priced into money markets. You can see here 26 basis point or so. So 25 basis point rate increase nailed on. Certainly the Euro's reaction will depend mostly then on any messages about future moves and not the rate hike itself, with then at least one more 25 basis point hike priced in for the following two meetings, either in July or September. That's seen by money markets at the moment. To recap then, events at the previous meeting in May, the ECB stepped down to 25 basis point increments from previous 50 adjustments, with the need to keep on hiking justified by the judgment that the inflation outlook continues to be too high for too long. And then the reason for the smaller rate increase was based on the view that past rate increases are being transmitted forcefully to euro area financing and monetary conditions. Since that meeting, we've had, you can see here, headline inflation falling to 6.1% from 7%. The core measure as well, that fell to 5.3% from 5.6%. And then also we mentioned it last week, actually, ECB's consumer expectation survey for April saw the 1 year ahead inflation expectations decline from 5% to 4.1%. So quite important for policymakers. They certainly look at that kind of report. And then also the 3-year view actually fell below, well, from 2.9 to 2.5%. So interesting couple of pointers for the ECB, for President Lagarde, although she has said that despite those sort of disinflationary impulses, so falling inflation, she's reiterated that inflation is still too high and set to remain for too high for too long again. We like that phrase, but it's helpful just to understand what they're thinking or what they have been thinking. And she also added that the ECB will keep moving forward, but that's this meeting certainly. But then after that, well, the Eurozone economy sort of well, it's fallen into a technical recession, actually, according to the latest revised GDP figures. And I'm not sure, sorry, that figure there is erroneous. So please ignore the 41K, actually. But 6.1%. But we then had, as I say, that probably should have been the GDP number, although it's a lagging indicator. Sorry, ignore that. Or ignore that. That box at least, apologies. Yeah, GDP denoted a technical recession. And then we've had also troubles in the manufacturing sector, long-held troubles really leaving its mark in Germany especially. So in terms of what happens beyond June, as I say, chances are of a further 25 basis point moves, around 75% chance still in July. But for now, the ECB will likely continue to stress probably its data-dependent approach, so look out for that. And therefore, any calls probably for next month will need to be premised on how the data plays out between now and then. Beyond July, then potentially markets will be paying attention to the new fresh staff economic macro projections and really how medium-term inflation forecasts align with the ECB's mandate. Interestingly, I know some economists, I think, are sort of due to the recent inaccuracy of ECB projections, kind of going to take these forecasts with a big pinch of salt, just to sort of mention that. But generally, sort of the economy or economic growth kind of rolling over slightly, inflation moderating. Potentially then the ECB could be slightly more cautious. And that's certainly some thinking. Then the last thing the ECB wants to do is certainly kind of pour more gasoline on the recessionary fire with more hawkish talk. Mixed views out there, so will be interesting, will mean volatility in the euro. Let's now look at just euro dollar, certainly, which is just here. In fact, I'll just give you a graphic which is moving on. Certainly this graphic is interesting for us because it's euro dollar in the blue line and then been tracking, basically, don't want to get too in depth, but again, sort of bond yields and the differences between those bond yields called rate differentials, and they've been driving the sort of euro dollar very recently. It's the German 2-year bond yield for you guys, the Schatz, against what is called the Schatz, actually against the US 2-year Treasury. And if I just show you, excuse me, that chart, which then maps, you can see that chart, which I've got on the graphic that I've just shown you. So that's it anyway. And we've come off there, eased really. Well, you can see the differential widening. So that means euro rates widening further away from US rates recently, but then we've sort of stabilized and slightly reversed that, although we're going lower again. But that has offered, well, seen selling in the euro, of course, if we just go to here then, but then a sort of stabilization more recently. So this is the euro dollar chart. Interesting price actions through June's kind of reflected clear sort of euro accumulation on weakness. Now we've got this sort of base formed around 107, potentially a rounded low really, which means then the euro could potentially stabilize and push higher. It is a bullish sign, a rounded low, typically followed by more dynamic gains after sort of minor consolidation. So potentially more upside. Certainly looks like for us, we'd have to break, well, the halfway point of this sort of this year's move. Let's just bear with me. Yeah, this year's move although it's been sort of slightly roller coaster ride. This year's move, halfway point of that is at 107.88. That tracks with the 100-day moving average at 108.05. So potentially we have to break that, which is the top here. Otherwise, then we roll back towards 107, and then 106.35 is that key low from the end of May. That's euro dollar. How long we got? I'll just touch upon then the Bank of Japan. They are meeting on Friday. Just bear with me 1 second. Pull up dollar yen, which is here, this chart. Yeah, Bank of Japan, well, looking at economic data alone, tempting to speculate that some tightening possibly is warranted. Economic growth kind of turned, well, it did turn positive in the first quarter. Inflation, certainly highest levels in 3 decades. And the outlook for wage growth has brightened after the results of the spring wage negotiations. However, Bank of Japan not convinced entirely that this is sustainable. Governor Ueda, he's warned that inflation will likely cool off later this year. Other speakers as well, other officials saying the same thing. Really doubtful that victories on the wage front will persist. Additionally, of course, as Bank of Japan is concerned about potential global slowdown, and then that would, of course, inflict some potential damage on Japan. Patience, really, we know that with the Bank of Japan, still got uber dovish policies, measures, or monetary policy measures in place. Really, policymakers then, they want to see credible evidence that inflation will remain sustainably above their 2% target before it phases out this massive stimulus. And that means kind of policy tweaks may take some time. Simply waiting until July, certainly that would give policymakers new economic forecasts, and makes then a meeting more realistic candidate, potentially July then for possibly tweaking to some of its policy measures, possibly that yield curve control band as it did back in December when everybody got excited about this regime shift, if you like, in those uber dovish policies. We haven't had that. Ueda hasn't said that he's going to do that. It's not the right time at the moment. The yen then, that means it's kind of mostly at the mercy really of external forces, which means how every other central bank is acting, how global risk evolves as well is key for the yen, as it is a safe haven. So dollar yen, let's just pull this back. I think really good, these fib levels here of this fall from those highs above, where were we, 151.94 down to the lows in mid-January at 127, sharp fall, broke out of that sort of descending channel, oscillated slightly sideways, but then pushed up above that March top at, where were we, 137, I've got it slightly different, where 137.91, I should see it there. So interesting break above that, held above that, so strong support there, and then pushed up towards the high, probably 140.93, yeah, is the high, and then we're tracking sideways, which is on that dotted line, which is the halfway point of the decline from that 151 high, and the middle 50% marker at 139.58. So it's just tracking around that level. Next upside, if we can level, if we do break higher, will be 140.93, so the recent high, and then 142.49, the next fib level. Push down below, sort of initial short-term support around 138.42, and then you've got that 137.91 level, which we quite like, and it capped the upside there. You can see at the start of May. Okay, we'll wrap it up there. We've been quite some time. Sorry, didn't have time for the UK data, but we'll look at that next week, certainly, because we have UK CPI data next week. Yeah, on Wednesday, 21st, and then, of course, the Bank of England meeting. So we'll review, certainly next week, that Labour data out of the UK, as well, of course, the Fed meeting impacted by CPI data tomorrow, and then we'll review the ECB and the Bank of Japan as well very quickly next week. Okay, hopefully that's proved of some use to you. I don't see any questions, so all clear, I hope. Please do follow us on social media. And as I mentioned, we do print everyday commentary on the website. We do have a week ahead piece as well. Plus that daily commentary has a chart of the day and sort of a look at the day ahead, slightly in more depth, and sometimes some market thoughts as well. In fact, we do have a question. Yes, please. Marco, yes, if you do have a question, then please do type it away. Or if you're just saying thank you, your first time here, then really appreciate you registering and listening all the way through 48 minutes or so. Hopefully, as I say, it's been of interest. And please do come back to us same time next week, as I say, reviewing those meetings and looking at next week. Just this question then. Why is the integration with TradingView on hold? Ooh, that's a good question. That's probably for an expert, which I am not, as to why the integration with TradingView is on hold still. Let me ask someone, and then hopefully they will have your details, I'm sure, and we can send you an answer if that is okay. Sorry, I can't help at the moment, but I will certainly take a note, and we will get back to you via email, if that's okay, Marco. Let me just make sure I write down. Oh, yeah, perfect. Okay, I appreciate that. Let me just jot that down, Marco. Great to have you on, and all you other guys. And as I say, please do read our daily commentary, sort of same sort of style. And we will speak to you next week. Yeah, have a great week and safe trading out there. So much going on. Just watch and keep your risk management in place, or even just sit on your hands and just see what price action develops then, because it potentially could be volatile. Okay, take care, and we'll speak to you next week.